Hello and welcome everyone. Thank you for joining today's webinar, Delivering to the Long-Term View in a Digital World. My name is William Ferrand and I will be your host for today's presentation. Before we start, I'd like to cover a couple of housekeeping items. So we'd like to keep this as interactive as possible, and you'll be receiving a couple of polling questions that will come up on the screen before you, so do watch out for them. At the bottom of your audience console, you'll also see we have multiple application widgets that you can use. So if you have any questions during the webcast, please click on the Q&A widget and submit your question. We'll allow some time at the end of the webinar for questions and try to go through as many as possible. So don't be shy and do ask throughout the webinar. Last week, we had some really great questions that actually brought through quite a few more insights. So I'm hoping for more of the same today. Finally, we'll be sending out a recording of the webcast as well as a copy of today's slide deck following this presentation. The link will also have the two previous recordings in case you missed them or in case you'd like to go back and cover them again. So today, I'm very fortunate to be joined by two very exciting panelists with Ralph Heim, the CEO of Finsight, and Charles Smith, who is Global Head of Digital Solutions here at Refinitiv. Ralph is a German technology entrepreneur and founder of Finsight, as well as Finsight Ventures. As a pioneer for digital investment solutions, Finsight creates asset management for a connected digital world. Before Finsight, Ralph headed the business development of a big data company with exits to PwC and SAP. Starting as a freelancer at the age of 16, Ralph spent his career building analytical systems for companies as well as central banks. Charles is responsible for driving the strategic direction, business planning, and financial results for the Refinitiv Digital Solutions business. Prior to joining Refinitiv, Charles was a managing director in wealth and asset management practice at Ernst & Young. So he's developed a deep knowledge in wealth management product areas and is an inventor on 8 US patents on process and product designs. Over the last 15 years, Charles has worked extensively with many of the top 10 US financial services institutions with a focus on product strategy, platform design, digital strategies, operating model development, and process improvement. Prior to joining EY, Charles had a senior leadership role at Fiserv CheckFree, which is now Tegra 118, and Mises, which is now Finastra. So I think it's fair to say that we've really got a wealth of experience today, and I'm delighted that they'll be able to draw on experiences from consulting and technology and really give us both a US and European lens as we look through some of the differences. So in terms of what we're going to cover today, we're going to start by looking through what some of the differences between Europe and the US are with regards to financial planning, as well as how things have evolved in recent years. COVID obviously on our lips as well, how that has changed things, how data requirements have changed as well as that, and really looking forwards as well. So I think I'll start with Charles, as you have more US experience than the US is probably ahead of where we are in EMEA. So what are some of the things, Charles, that you've been seeing with regards to digitalization of financial planning?
Sure. Thanks, Will. Thanks for having me this morning. It's great to join you and Ralph in this conversation. I'll talk a little bit about the US in terms of financial planning. It's been a big shift over the past 10 years. I think 10 years ago in the US, we saw financial planning as a centralized function that was reserved mostly for high net worth and ultra high net worth clients who were willing to spend a lot of time with a private banker or a planner and really go through it and do a full financial plan. Something that usually cost in terms of dollars, $5,000 to $10,000 in fees just to do that plan. It was so intense and in depth that it took quite a bit of time and usually a couple of weeks in which to do that plan. Over the past 10 years, a lot of the wealth firms in the US have tried to shift that model a little bit and go after more of the affluent space. And the way they did that was come in with new, more modern, more nimble ways of getting planning in front of those clients. I think 10 years ago, you saw the launch of two fintech startups, MoneyGuide Pro and eMoney, which really were designed around the concept of goals-based planning, which would allow investors to think more the way they think about planning in their minds and compartmentalize how they save. That I'm saving for retirement, I'm saving for education, I'm saving for a vacation home. And those platforms really built their concepts and their tools around that framework, allowing investors to think about how they save from a goal perspective, determining what they want to save for, allowing them to prioritize their goals, to define what risks they want to take for those goals, and put some of the control back in the hands of the investor. The other thing they did was they gave the advisors more tools in which to work with those clients. So as I mentioned, for years, it was more of a centralized function where there's a CFP team that did a lot of the work internally. This put the control of the planning in front of the advisor. The advisor can then have a conversation with that client about the goals, about how they can provide advice to that client about how to achieve those goals, what investments they need to invest in to get to those target numbers. So you see more and more of that advisor-client engagement model happen. And those tools were also allowing the advisors to scale their business as well. So it was not a in-depth financial planning process. It was more of a lighter 1 to 2 hour conversation with the client to get them engaged with the advisor, understand what they need to do to achieve a goal, and then go about setting up their funding and the allocation to get to that target number. You've seen a lot of tools pop up since then. You hear a lot about Mint.com and some of these other budgeting and planning tools that are purely client-facing. No advisor is involved, but I think the ones that have been the most successful in the U.S. are the ones that allow the clients and advisors to work together through a digital channel. I think it's allowed these advisors to reach more clients, to scale their business, and to put some of that financial planning tools in the hands of the clients, and allow them to become more engaged with their wealth provider.
Okay, no, thanks. That makes sense and actually fits in quite well with something that came up in the first session that we did, where Thierry, and Ernst & Young person as well, was saying that actually digitalizing the interactions between the advisors and the clients was something that has come up a lot during COVID. So it's an interesting thing. And Ralph, in terms of, I guess, a European perspective, how does it differ? What's direction we're going? What do you sort of see in Europe in terms of where we are on that sort of journey that Charles has just been telling us about?
Yeah, I think generally that's a very precise description of what happened also here. So we have some tools which always were B2C, so directly for the user. At the moment, in most countries in Europe, there are some examples in the UK, for example, which are doing a bit better jobs there, but usually the ones are not today like adopted by millions of customers, more like kind of nerd tools, let's say, which are used by just a few customers. So the bigger market at the moment is like Charles also described from the US, is a market where advisors are engaging. And that's something very interesting because Europe is not Europe. And there is not this one financial planning process which is across Europe all the same. And the reason for this is basically that the market infrastructure is quite different across the European countries. So you have some countries where there are a few banks dominating the advice space and offering their tools, which are often then also a bit outdated in the larger corporates today. And you have another market where then, for example, IFA structures or EAM, or every country calls it a bit different. So smaller companies, smaller advisor firms are stronger. And those are usually today local markets, and are also that's why you find little software which is like the ones described by Charles, like Europe-wide, very successful. So you have some French providers which are doing good jobs there. And the reason is that custodian structures differ, tax differs. Now we have the first time that regulation with MiFID II and with also open banking and PSD2 and so on, there's more regulatory framework which guides across all European countries. So I think that's what is currently a big window of opportunity for Europe, because it now more starts to bring on software experiences and customer experiences which are really superior to what we've seen in the past years. So, and for me as a customer, I always wondered why I'm not able, for example, to use a platform, a financial planning platform where I just can connect my accounts, or set my objectives, and everything is real-time tracked. I have a great customer experience because I can always see how far I'm in line with my goals and so on. And this is currently coming up now, given that across Europe more and more standardization is happening, and this is now flowing also across single countries. But it's very, very much the beginning of a journey there, where the US, I think, is quite some years ahead.
And I guess you talked about the fact that in Europe, we're more fragmented with the setup and, tax and things like this coming into play. And that means we do see more niche providers across the board. How do you see things in terms of buy versus build? Are people do you see more banks trying to build their own, or do you see them more trying to buy things that off the shelf, I guess?
Yeah, I think we need to be a bit more in the detail then. So there are banks which have their own advisory workforce. So, for example, we have one customer which has 4,000 advisors directly running for him. And then we have also enterprise you do not know from the press, let's say. There are like distribution pools or platforms that have sometimes 30,000 advisors, 40,000 advisors. And you do not see them visibly, but they provide the technology that these advisors do. And for an advisor, it's extremely important that I can have one interface where I do my financial planning, and I can also do the advice. Because if you do not link the two, you have a lost or you have a broken customer experience. Then the financial planning is just some sort of, I do a theoretical model with the customer, but it's not manifesting in an investment advice. And so what you see is in Europe is that given the structure we have, that often then the custodians, the pools, the distributors, which are also sometimes companies with 20,000 advisors, and you do not know them from outside of Germany or outside of France, these local structures, they come up with software, and they usually take or open to take standard software from outside, but they want to have it tailored to their investment universe. So the products they offer, that's a regulatory issue also in some degree. And they want to have it embedded into the existing customer experience platforms. So that's why you see they do not take the plug-and-play software from next door and say like, oh, this is at work with custodian A, custodian B offers exactly the same one. This rarely happens. They build on the same software, but still these are like you have to compose some things in order to be able to serve these customers, or this B2B players. And most of the advisors are attached to some kind of B2B player, either the custodian, the pool, other organizations. They usually do not buy software themselves that much. And that's also different, I think, from the RIA infrastructure in the US.
Yeah,
I think well, just add on, in the US, we've seen very, very few firms now tend to build everything themselves. I think there's so much capability out there, so many firms that can provide, as Ralph was talking about, the parts and the configurable capabilities that could be plugged into other platforms. In the RA market, they've taken these tools like MoneyGuide Pro and eMoney that I talked about, and they've been built to be configured to the end user and the firm they're working with. So most firms today look to their providers to give components that are configurable that can be embedded either into other platforms or into a homegrown solution that's already been built. But there's no need really at this day and age to go out and build everything yourself. I think there are very many firms out there that have the capabilities to provide what you need from a planning perspective, from a data perspective. You can take those and use their APIs, their capabilities to embed inside a solution. So I think we're moving to a model where you're looking for best of breed that can be integrated into your overall solution.
Great. I think that leads us quite nicely onto the first question, which is how the audience goes about financial planning. Maybe, so I put it up, do give an answer. Maybe we should have had something about, whether they've built themselves or whether they've bought off the shelf, or, as Ralph said, tried to configure something that's come in. So yeah, do start to submit your answers and let us know how you're currently working.
I think it'll be interesting to see the answer to this. I think I don't think software will be as high as you think. I think there are a lot of folks out there who are still doing things on their own offline. So I'd be interested to see how they respond to this.
Yeah, I can see the first few responses starting to come through, and I think you're going to be right in your prediction, Charles, that software might not be as high as we might expect. Just give it a few more seconds for the last few to answer, and we'll pull through the answers. So if I pull it through, interesting that most people are, as you say, Charles, sort of looking at questionnaires and plugging into Excel models. I guess, why do you think it is that the sort of software answer, which to me seems quite logical, is quite low down the list?
Yeah, sure. I'll give my perspective then. I'd love to hear from Ralph too. I think in a couple cases, one, the software that's out there can fill some gaps, but is not complete yet in a lot of cases. But primarily, a lot of the advisors I've worked with in the past tend to stick to their old ways, right? They've always worked either pen and paper, or they've always worked using Excel, and it's hard for them to change to a platform that isn't as flexible as what they're doing, today. So Excel can be as flexible as you need it to be. So you can build your own macros, your own models, and use it as you need to. Some of the tools out there, historically have not been as flexible. So I think that's changing. I think a lot of the tools that are coming out now are flexible, can do things that you can do in Excel, and they have better ways of presenting the information. So I think you'll see a shift over the next 3 to 5 years in Europe, especially moving more to a CFP software type model as those new tools become more prevalent. I think Excel is limiting. It doesn't give you the same presentation that you can get from a platform. So I think you'll see advisors start to move away from Excel when other folks who are now more engaged, right? The more millennials who are using more tools digitally, they're getting that digital experience. They're not going to want to go back to an advisor who uses an Excel model to present planning. They'll want to come to an advisor who has the latest and greatest and can do something online that they can interact with, over time through a digital engagement model. So you can do your plan with your advisor. You can log back in a month, update your plan, update your priorities, update your goals, have it adjust, in real time versus having to call your advisor to update an Excel model. So I think this will shift over the next couple of years as more tools become available, as more firms realize technology's there, and that as advisors understand that they need to evolve as well. Right? Post-COVID, I think this will force advisors to update their processes, update their mindset, and how they work with their clients.
Yeah, I perfectly agree to everything Charles said, and I have two things I would add. First, I believe convenience is the most important driver for software adoption. What I mean with this is that if you cannot, let's say, use the software and keep it up to date within some minutes, it's for you, it's a lot of burden to do it. And if you look at financial planning, which is as complex as our lives are, you have to often adjust things, or your life adjusts, and you have to adjust things, and your objectives adjust. And I think in order to deliver a customer experience really worth the effort is something where we see now with open banking, the connection of accounts, being always close to it, always be able to experience something which is really tailored to you, and not just paper and pen exercises you do every 2 or 3 years. It's a totally different experience. And past software could not deliver this experience, also due to technology advancements. And so I think that's really one thing where, at least in Europe, we see that technology advancement. In Germany, we had FinTS very early on, an interface which could allow us to aggregate accounts. So we were experimenting with this very early on, 3-4 years ago. And we saw that this is a really important driver. And the second one is that if you look at larger organizations, that a lot of this software, like I said before, is delivered to advisors from larger organizations. These larger organizations have legacy in place. And sometimes when you want to connect the legacy, you want to connect an existing order management system, an existing portfolio management system, or an existing custodian interface. You would need to build this in a way that you can connect to this. And if you look at standard software and you would want to go, like in, let's say, e-money, or you want to go to Europe directly, you would have had to build these connections, or would be knowing how to build these connections. And otherwise, you will just be a fraction of the value chain. And if you're just a fraction of the value chain, you can also use pen and paper. So that's, or you can use plug and play into Excel. And I think that was what advisors were also experiencing in the past, that they saw software, they might have liked it, but they say, like, it's not integratable with my infrastructure, so I use the same old.
Yeah. Good point. I think one thing to add is, I think the key differentiator here, and that drives advisors to use these tools more, is data, right? And there's a couple different types of data you need. One is definitely getting that client data captured, having a full picture of the clients. You can provide that full plan. And you can use Excel to do some of that, but you really can't do it at scale without having a data platform. So, here at Refinitiv, we're rolling this out next year, our client data layer, which allows the advisors who work with us to collect as much data about the client as possible, not just profile data, but custodial data, planning data, CRM data, all into one consolidated platform. And the other is data about the investments, right? You need to have a full picture of what you can offer a client in terms of investment information, ESG data, things that allow an advisor to have an advantage over a client doing something on their own. So the ability to pull the client information together and provide investment insights, right, you can do through data, is something that gives an advisor advantage. And once the platforms have both of those together, you can have a CFP software planning platform that will drive the advisors to use it, because it'll give them something that Excel can't do.
That's interesting. Sorry.
Yeah, one thing to add to Charles, because that's perfectly exactly what we see here, is that once you are able as an advisor to provide your customers something else than just the performance, so something that is saying, like, hey, you are on track with your goals, the conversation starts to shift to an entirely new experience for the advisor-customer relationship. Because you can say, like, hey, see, you're on track here. We managed to get here. The return was 6 point something on average. It was good. But also, if it was 2 point and we still managed to reach the goals after some years, it's something that is for the advisor conversation something totally different. And also, you can trigger the advisor conversations upon not reaching goals then for the first time. Which is something also completely different from a customer perspective, because in the current advisor relationship, often, and it's a bit like, yeah, not so nice sound, but sometimes it's like better the customer never calls, right? And this is something which is on the long term not that good from a customer experience. And if the customer can regularly see, I'm on track, I can reach my goals, and that's the reason why I'm not calling, instead of I do not know what's happening, and that's the reason why I'm not calling.
And I think you've sort of touched on it a bit there, and about the not calling because you know where you are and being on track. And something you touched on earlier was, I think Charles talked about it with Mint, but is the sort of DIY approach to things. Is that a shift? I mean, Ralph, you said a few minutes ago that, as you said, financial planning is extremely complicated because it's everything that's happening with our lives. But are you seeing more demand from millennials or generations coming through for DIY tools where they're really trying to do it themselves? Or do you think that the advisor side, is sort of as strong as ever and is as appreciated as ever? Because I see it as something that's incredibly important, but something that needs to always add value.
I have a very untypical opinion on this for, I think, a technology entrepreneur. I actually believe that the advisory workforce will increase. Why is that? Or we will have to need to have more advisors, because what we saw, and a lot of also robo-advisors, for example, are on our software running. And we saw even robo-advisor, the people got called more often during COVID. So you are a completely digital platform. You offer a completely digital value proposition, and the people call you. And I think that's even without financial planning. And if you take financial planning inside, it's even more, because it's the complicated lives we have, like I said. And I totally believe that software will enable advisors to handle more customers, bringing down the average marginal costs for a customer advice. For customer advice, we have banks where this costs us now in the two-figure thousands per advice, because of documentation and all this process costs they have. And you think, like, okay, of course you can just offer financial planning, what Charles said at the beginning, to the very wealthy, if you say this advice costs me like 15K or 20K. And I believe that this marginal cost will decrease due to technology. And we saw this with some banks already, that they reduced the advice, the time they needed for one advice, including a financial planning, to 1 hour instead of preparation, post-preparation, 5 hours or 6 hours. And this allows you to handle 3 times more customers, bringing down marginal costs, allowing to serve more customers. And what we see also, and I believe also there will something happen, we talk a lot to brokerage firms at the moment, because they also say they saw rapid growth over COVID. So brokerage customers, we have some, are like, they really like expanding fast during COVID. And what you see there is that, these are do-it-yourself customers. But they are open if you trigger them knowledge. They are open if you trigger them, like, this is your portfolio allocation, where you're aware of it. You have a huge cluster risk there and so on. So I think what we will see more and more in the next years is that anybody who's invested will have a more seamless experience within regulated frameworks, of course, between what is advised and what is non-advised. And if you can offer that, I think the human role will get more and more important, because more and more assets can be, or more and more people with assets can connect, for example, to a human in a short way and get feedback on this. And I think this will change the way advice is provided, and will increase the efficiency of the advisors by big time and the audience they can serve.
Yeah, I agree 100% with Ralph. I think you need to have digital tools to engage with the client, especially the millennials. They want to do things. They do want to do things on their own, use their own tools. But at some point, you need sophisticated advice from someone who has seen a lot of these scenarios and goals pop up before. And that's where an advisor comes in, right? So, I do some planning on my own myself. I use Mint.com as well, but I do have an advisor who helps me out for those more complex issues. I could do some basic planning on my side, but when it comes to getting information, data, insights from what other people like me have done in the past and how they've been successful or not successful, that's where the advisor comes in. So I can do more complex estate planning, insurance planning, college planning with my advisor that I can't do all on my own, because he's seen more than I have seen, right? He's seen people like myself go through this, and he knows what works and what doesn't work. He has more sophisticated tools. He has more data, right? So I use him as basically as part of my planning process. I work with him to do the more detailed analysis, and I keep the basic, the budgeting, and the basic insights is on my side. So I think, as to Ralph's point, advisors will become more and more important, because you get more data on your own, you can do more on your own, but you can't do all the heavy lifting without the help from someone who has the insights and the data that can really give you, what you really need from a full plan. So I think you'll see more advisors become more important as things become more complex, as the world changes. It changes, obviously, in this world, especially daily, right? You need someone to help you, guide you through that. And that's where the advisor is going to come in.
Yeah, I guess that makes sense. I guess sort of it, on the one hand, is sort of democratizing in that you're bringing more people on board, but on the other hand, that interaction with the advisors changing in that they really are sort of adding value rather than just sort of providing a little bit more information. So that's really interesting. And another side that, Ralph, you've touched on a couple of times is account aggregation, and you sort of touched on the beginning on the regulatory side with PSD2 and the importance of account aggregation to create a full financial plan. So before we sort of dig into that a bit more with Charles and Ralph, I'd like to understand what the audience thinks. Would you be willing to connect all of your accounts and sort of give your full net worth to your wealth advisor if it gave you a more accurate financial plan? And I'd be interested to see what the response is on this one, and something we can go into a bit more, because I'm sure that it's something that, depending where you ask the question, you get very different answers.
Yeah, I think part of this will be security, right? Do people feel secure that it'll be, encrypted and well stored? I think that's part of the problem today. Let's see. It'd be great to see what everyone thinks. I know I do give my advisor access to my accounts. It allows him to get that full picture, right? Without the access to that data, he can't really tell me exactly how to best allocate my investments to achieve my goals.
Quite interesting so far. I'll give it a bit more time for more answers to come through. But no, I'm quite surprised actually at the results coming through. Give another 5 seconds or so and see what people are saying. So yeah, we've had an overwhelming yes in terms of people saying that they would be willing to connect all of their accounts. So it looks like we have a more open audience than I would have imagined. And I guess, Ralph, do you want to talk through, I guess, the importance of connecting the accounts and, some of the things that you're doing on that side?
Yeah, definitely pleasure. Yeah, I'm actually I'm not surprised that it is a yes, but by the sheer number of 92%, it's quite a surprise. We see this actually as a clear direction. So you see that actually at the moment, like players in Germany, we have like somebody like Finanzguru, but there are similar ones in different European countries which do account aggregation, and they provide at the moment very limited features. So just budgeting a bit, let's say, right? And still, you see that they have millions of downloads. I think they're close to 1 million now, being 3 years live now. It's not a super great adoption, but you can see it's growing. It's really growing. And you see at banks, I think one customer of us reported very early on that they have a multi-banking aggregation after 3 or 4 months, they reach 4 billion in aggregated volume, which is big accounts and gets very fast with deposits. But yeah, we see this, and I think it's very important. It will grow further when you deliver value. So aggregation is just a means for me to get more insights. So when I want to go to a bank and I can aggregate, I go to bank B and I come with a cash account and deposit from bank A, and I can get a second opinion on the investments I did, or bank A delivers me a complete experience planning, looks at my expenses, can see how much money I spend on certain things, can say if this stays like that. And the best proxy we have about the future is sometimes today, right? Because our expenses today are an indicator, and every year passing by, it gets more accurate for what we need in the future. And if you take that together with some statistic data in the future, but even that data alone is a great help to provide a more accurate picture on if I meet my retirement goal, for example. And this simple answer is very important for many people. So just from your cash account, you can say you have a probability of reaching your retirement account at 72%. I mean, this is highly inaccurate today, right? But it still gives you a feeling, and it also gives you like a way to look for optimizing this. And you can set other goals. And I think it's very important that aggregation is not a means to just provide some overview, but also a means to provide some insights. And this is what financial planning is built to do, I think, in this case.
Yeah, it comes down to trust in this case. If you trust a provider to aggregate your data properly, to secure the data, you trust your advisor to work with the data, and not try to oversell you on new solutions. This is in line with what we've seen in the US as well. It's become more common, more accepted to do data aggregation. It does benefit the investor when that advisor has the full picture. So I think this is in line with what we've seen. And I think the willingness of the folks, people to do this is going to allow the wealth business to really come to its full potential in providing advice to clients if they give that full picture of what they have in terms of assets.
And Ralph, I guess we've seen, the overwhelming response here. We're sort of 2 years into PSD2. You talked about one app that was getting up to 1 million users, but I guess open banking hasn't taken off quite as much as we'd expected to. I was reading an article saying that numbers have sort of doubled in the last 6 months, so things are starting to pick up. But why do you think, given the enthusiasm that we're seeing here, things maybe haven't been quite as quick to pick up as we may have thought, leading up to it as well?
Yeah, I think that is a very fair question. And if you look in Europe, there are different countries. So so for example, in the Netherlands, there were a lot of fight between the banks also in the past on how can we do aggregation? Is this allowed? Is this legal? Is this not legal? This was a huge topic 5 years ago. And in Germany, we had a standard called FinTS, which was used for cash account aggregation. And this has been used quite widely, and it was actually a good standard technology-wise also to work upon. So while for the Netherlands, PSD2, for example, as far as I experienced it, was something new, some new capability. In Germany, it was more like, let's see if PSD2 is as good as FinTS was in the past. And we had things in the regulation like strong customer authentication. So having a second, you get, for example, an SMS or another kind, the TAN apps, I think you know all this kind of second factor authentication. And what you saw then was a drop in usage. So before PSD2, actually some aggregation applications were very much more used. And you saw then a constant drop afterwards because strong customer authentication killed and the processes were not good, PSD2 APIs were not ready, and there was a lot of uncertainty coming up from the regulation more than actually it driving the open banking at the beginning here in Germany. And that's why, for example, we noticed that now as it gets more stable again, customers are used more to strong customer authentication, it gets more, and APIs are working better, it gets more adopted again, but I think PSD2 was in Germany more slowing the adoption process compared to before. And also still, if you look at cash accounts, it's just cash accounts, deposit accounts are still today via screen scraping, often in many cases aggregation, or via custodian integration directly, which is an effort. And so you see that basically in different countries in Europe, the adoption was different. For some, it's now a very cool thing, very new. For other one, it was more like a hurdle to get now the strong customer authentication and the processes to get still a good customer experience on it.
Okay, thanks. And I guess, Charles, in the US, where you don't have it sort of from a regulatory perspective, do you, and so being based in EMEA, I don't have as much of a view of the US, is account aggregation something that you're seeing a lot of uptake on?
We definitely are. There have been a couple of firms in the space for quite a while. It's pretty well accepted here. Firms like Yodlee, Quovo, which is now owned by Plaid. It's definitely been much more accepted here in the U.S. I think it's starting to. There's less regulation, obviously. I think, but I think we've seen the aggregation take off. I think we don't have the same standard. Like I said, we don't have the same standards that Europe does. I think that may change with the new administration coming in here in the U.S. But I think it's something that we definitely see most people are very comfortable with doing.
Yeah. Thanks. And I've just seen a first question that's come through, so I'm sort of wary of time as well, which actually sort of takes the conversation slightly away from where we've been, but is an interesting one nonetheless, which is around sort of data requirements and how people are looking in terms of their investing. Charles, you talked about ESG earlier on. What is the sort of ESG appetite and how does that fit in with financial planning and financial goals? So maybe one for you, Charles.
Sure, I'll start. I'll see what Rob has to say. I think it's extremely important. I think ESG of the past year has become much, much more prevalent. I think, as I mentioned earlier, right, if you're an advisor, you have the ability to pull in data that you can't, that an individual investor can't get. And one of the things you can get as an advisor is insights into ESG scores for companies. And if you're an investor, it's become much more important to you, most investors anyway, to understand where these companies are going, what their philosophy is, and how responsible they are as firms. So we're seeing a much higher demand for ESG data, and that's something that I think a lot of the planning tools would have to incorporate as they go forward. Is when you get to, and I think Ralph told this before, when you work with the clients about understanding their goals, prioritizing their goals, understanding their risk profile, but also understanding their preferences. And that's where those things together allow the advisor to get a full picture for the client and pull in the right data to understand how to invest them appropriately. I think ESG, I think for years you've heard ESG returns might be lower than your standard investments. I think that's a myth. I think really now it's about a gradient. It's understanding not whether they're socially responsible completely or not. It's basically understanding how responsible they are as a firm and balancing your portfolio to have the right set of investments to align with your preferences. So ESG, I think, will become a key component of the investing process. There'll be a question you ask the investors as you go through the planning cycle, understanding where they stand, what their importance is to them, and having the view of ESG data is going to be really important for an advisor to have.
One thing to add, Charles, in Europe, it will become mandatory also to ask this question, like the sustainability, to build a profile around that based upon the requirements that are currently defined. And then you have something like within MiFID II, so that when you generally propose an investment, then you have to also ask about the interest in sustainability. And if it's replied with yes, you also have to take it into account into the investment proposal. So that will definitely be also impacting ESG diffusion in Europe a lot.
Yeah, that's coming in March, I think, in Europe. No, that's interesting. And I guess from a sort of personal question, you talked earlier about having the two sides of data. So having the data sort of information on your clients and pulling in all of the account information to sort of create this full picture of what you'd like with the risk. Are there sort of new data types coming in or new requests, I guess, from your clients for different types of data to sort of pull through?
I'll take that. I'll start quick. I mean, I think one thing you're going to see a trend happening is not just structured data, right? Not just data about their investments, things about their profile. You're going to see more social media data get pulled in as well, I think. So I think to get a full picture, you need to really understand the person as an advisor. So I think you'll see more information from social media outlets such as Twitter and Facebook and the like getting pulled into the full picture. When an advisor sees a client, they want to see not just the factual, structured data, but also their life outside of that. So seeing information about their personality, about their social media posting, things like that, to get a full picture of the client will become more important, I think, going forward. So I think you'll see a trend towards, gathering all types of data. The other thing would be not just surveys with firms, understanding whether they prefer, they're happy with your service, but also looking at call logs into the service center, looking at email transactions, just kind of analyzing everything that goes back and forth to give the advisor the full picture of the client. So they need to understand that they may be having interactions with that firm beyond the advisor. So calling to the call center for questions, logging on to the website to ask, to go into a chat window to ask questions. Getting the full picture of the client is more and more important. So I think you'll see more of that data get pulled into the full advisor view of the client.
Yeah, I think so as well. I think one really important aspect. I'm a huge believer of metadata. So metadata is data which is collected by the customer interaction, and what you can see, you can learn so much from it actually, because you can see like what kind, if you put something in the reporting of the customers, go into your dashboard, provide this to the customer. Is he viewing this really? Is he looking at it? Is this a customer type? And customers are hugely different. That's something which is not just reflecting in the way if they are self-execution or if they want to outsource everything and say like, just leave me alone and send me, tells me that my goals are in line. But so customers are very different. And if customers are very different, you can become very much better if you learn to provide your customers very specifically. So we will see, I think, way more on, and we currently test there a bit. And this is for banks or for financial advisors a huge thing, right? Because in the past, you never split tested. And so you made not two variants of one advice process and tested them. It's completely new, right? So now you can do it with digital end-to-end processes. You can start testing out different advice propositions. You can start testing out, for example, how does for this kind of customer convert? So does he really buy afterwards? If I test it in the first advice process or in the first meeting, that a retirement planning compared to advice structuring, so wealth structuring process, or into a topic investment process, or into, so you can test processes. And I think that's something which is extremely new and extremely powerful, because if you look at today, I have sometimes the feeling that every bank has some guy sitting there and he has a clear picture of what the future is, which is sometimes right, and it's not bad thing. And it's better than no picture. So, but it's still not tested with the customer. And when you can test different processes with the customer, you can learn how they actually interact. When do they buy? Is this customer activated with an ESG report on his portfolio? Or is he activated by something which tells him how he can increase the likelihood of reaching his goals? Is he activated by having a deeper insight into the portfolio structure and saying you're not too active in Asia, but for your volume you have invested, this makes sense. And all these nudges you can send and can really test, like, does he accept it? Does he want it? And especially when you have customer goals on the platform, when you have accounts on the platform, when you have the customer logging into the platform, which is the metadata I was talking about, you can learn so interesting things to provide a very unique customer experience because we're really all different. Our lives are different and our desires are different. And today banks sometimes don't even know if you're actually having 5 million at another bank, and you do not know your customer very well. This way, financial planning, but advice, aggregation, all these tools or things to get you to know the customer very much better.
That's a great point. That's a great point, Ralph makes. I'm sorry. One last thing to mention too is that the other thing you can do once you have all this data is play it back to the client and let them know how they're doing compared to folks like themselves. So doing cohort data and saying to the client, here's what you're doing, but people like you have done this in the past, and here's how you're doing compared to your peer group. That's very valuable data that clients love to hear, is like how they're doing compared to their people like themselves. So the more data you have, the more you can do with it. To Ralph's point, you can test it with them differently. You can use the metadata, the unstructured data a little bit more, and it give you a better full picture of the client. You can play it back to them and say, you may think you're doing well, but you're not. And here's what you need to do differently to kind of achieve what you want to get to. Here's what other people like you have done as well. So all that data combined can give you a better picture as an advisor, but also give them a better picture as an investor, how well they're doing.
Yeah, I think, and it all fits in quite well with actually what Steve McGraw was saying in the first webinar we did, where he was talking about customizing the customer experience to an individual rather than sort of to a group. But I like that, what you said, Charles, about taking it to the next level and then giving people comparisons to others. I realise we've already run over. We've got time for another question if one comes through, but I can't see any on the Q&A. So I think, unless Charles, Ralph, is there anything that you'd like that we've missed, or I mean, there's lots more that I'm sure we could discuss, but is there anything else you'd like to sort of quickly discuss over the next couple of minutes, or otherwise we can look to end?
I'm good. I think, Ralph, anything you want to share?
I think I learned that 92% of your webinar guests are willing to share data. This is already a good starting point, and I think this tells us a lot about a shift in paradigm we see there. And I think really COVID, you mentioned it at the beginning, Will, COVID really changed that a lot. Advisors could not serve their customers as they wanted to because they could not meet them anymore. That's a totally different change of habit. And having now some 1,000 customers on our software, we see that that for them it was huge stress to cope with that change. They called the customers a lot. They tried to send more reports out. They tried to to guide them through high volatility, to high drawdowns. Also, that was a super stressful time for advisors. And I think this year was quite stressful for a lot of advisors. And I think it showed the demand for such interaction. They are more open than ever, from my experience, to use technology to cope to such different times, to serve all their customers at the same time with the right information, with the right insights, and always showing also what this means for them personally. And I think there, the strong belief is that we will see more and more now the adoption of technology, given that experience we all made this year. And so this is, I think, one of the positive things of the current situation, that it will accelerate this change given the sad environment around it.
Thanks. No, I think you're probably right there. Well, thank you to both of you. Thank you, Ralph, for joining. Thank you, Charles, for dialing in so early as well. And thank you to everyone for listening. As I said, we'll be sending through the slides and the recording in due course. But yeah, no, thanks a lot, and have a good day. And this is the end of the webcast.
Thanks, Will. Thanks, Ralph.
Thanks to you also.